Hi, thanks so much for tuning in. You're watching BQ Prime. This is Stocks in Focus. My name is Alex Matthew. Let's take a look at where the markets are. They're more or less flat in trade today. But we're going to focus more on the names that are in the news and that are reacting to that news. And to that effect, let me introduce you to the guest today. We've got Prakash Gupta, who's the founder of Dhan, joining us. Jay, thank you so much for taking the time. And I want to start with the first counter, which and incidentally, we have quite a few counters that are reacting to earnings. So let's first look at those counters and then we'll go to a couple more. But I picked PVR Inox and I see that the revenue is coming at 1,143 or thereabouts crore for the quarter. And that's slightly higher than the consensus estimates, but the net loss is wider than expected. What is your reading of the numbers? You've probably seen the fine print. Was this according to your expectations? And how should somebody who's holding the stock behave? Should someone pick it up right now?
Hi, Alex. Thank you for having me on your show, first of all. As far as PVR Inox is concerned, I think this is the first result of the merged entity, which we've seen, right? So I believe that the synergies are yet to play out. As we heard the management today, they're planning to shut down around 50 screens, which is around 16, 17 properties, which they feel have become redundant. And they're also planning to add around 150 to 175 new screens. So I think, the overall outlook looks positive. And there are series of, new movies, the mega star movies are likely to get released. So that will bring a lot of audience again back to screen. Still, OTT remains a big threat because people have become used to watching movies or going onto OTT platforms. But one silver lining which I see is that as you have good releases and blockbusters coming, so people will come back to the screen. That's how the Indian society is. You always love watching movies on large screen. The average ticket prices have gone up. That's again a positive sign. The average ticket prices was higher by 3% in the last quarter. And as the synergy is likely to play out, combined entity of PVR and Inox will have a larger market share. So I expect the ticket prices to go up further. So that will also add up to the revenues. So all in all, I think the worst is behind PVR, it looks like, and the stock can be you can hold the stock, or if there is some kind of dip coming, I think the more can be added at I'll say 5-7% correction from current levels.
Do you have any targets that you can tell us about your expectations for the stock?
Based on what the management spoke, I believe that if somebody has, say, a longer term view, I think somewhere around 10 to 12% from the current levels cannot be ruled out.
Fair enough. Let's move on to the next one. Berger Paints from the Paints pack, and it's not doing too much in trade today, up about 1/3% or thereabouts. Revenue up as much as 12% or 11.7% or thereabouts. Margins are, in fact, have degrown compared with the comparable quarter. Net profit is down as much as 15.6%. I think a lot has been said, Jay, in the recent past about crude prices and the fact that they've eased off. So there could be margin tailwinds in the offing for these companies, and Berger also. How are you reading the numbers, though? And what, according to you, is the expectation for earnings roadmap going forward?
If I compare these results with their peers like Asian Paints and Kansai Nerolac, I think the numbers are not that great in comparison to the other two companies. But on the positive side, their decorative business has grown in double digits. That despite the higher inflationary kind of pressure which was there in last quarter. If the double-digit growth is also if we expect that in the coming quarter as well, I think the lower than the inflation number which is likely to remain for the current quarter is likely to be lower, and that will definitely add some kind of margins on the bottom line. On the industrial sales side, again, there is higher demand for coming from auto sector as well, so that's likely to help the company. So I think In terms of roadmap, the coming quarters are likely to be better than the previous one. The reasons being, one is the worst of inflation looks like behind us. The normal monsoon is likely to add up to the demand, and the kind of industrial sales numbers which is likely to remain stable. So these factors will add to the bottom line of the company. So a good stock to be in. I think with some kind of disappointment in the numbers in terms of expectations, the stock may correct around 5-7%, I believe, but that should be a good level to get into the stock.
Okay, fair enough. That's the view on Berger. Procter and Gamble, and this is a counter that has revenue growth of about 20%. EBITDA's come in at about 79.6 crore rupees. Here too, you have a margin contraction for the quarter gone by, and PAT is up about 15.7%. You probably read the fine print. What is your reaction to the numbers, and how should someone look at this stock?
Alex, I feel companies like Procter and Gamble, Colgate-Palmolive, ITCs of the world, they should be part of your portfolio and for any investor. There's nothing wrong with the company, and as I said in the previous stock as well, the fear of inflation looks like is way behind us, at least for Indian markets. And I feel that the sales will pick up further from here with certain delivery and grocery companies, new age companies that are also adding to the sales of a lot of FMCG companies, and with the kind of product range and variations companies like Procter and Gamble have, I don't see its revenues and margins falling further. So it's a good time to accumulate the stock, I believe.
Okay, but follow up to that, you mentioned Colgate-Palmolive, and if I look at the last few years, the stock hasn't done really very much. So would you say that it's important to set expectations when it comes to counters like this? You say it's important to hold in your portfolio. What role does it play in your portfolio then?
It acts like an anchor, when the markets are indecisive or there is high volatility, you always want to have certain stocks which provide some stability in your portfolio. And these are dividend paying stocks. You earn a good dividend. What is important is that your entry to these stocks has to be at right price. If you just go and buy at lifetime high levels, your dividend yield won't be giving you much of the returns. So I think the timing has to be very important. And as I said, that these companies should be part of your portfolio. Maybe in times like these, when there are a lot of uncertainties with respect to Western markets, and there is a fear that market may correct, which obviously we are hearing for last few months. But again, it's always better to have some kind of defensive stocks in your portfolio as well.
All right. The next stock, admittedly, I don't think that you look at very closely and very often, but still it's arguably the stock of the day. I'm talking about Astral Limited. And it is, in fact, if I look at it, a stellar set of numbers, at least on face value. Optically, it seems to be the case. EBITDA is up as much as 46% at 311 crore rupees. You have margins that have expanded quite significantly in the quarter gone by. EBITDA margin standing at 20.6%. Net profit for the quarter up as much as 43% at 206 crore rupees. And that is evident in the kind of effervescence that you're seeing in the market today. Stock is up as much as 8%. So what is your reading again of this company, and how should someone, a prospective investor in this counter, approach it?
Well, that's a phenomenal set of numbers. The best part was the net profit of around 43%, which is up. I feel that with the kind of infrastructure spending which the government has planned, the companies which are into pipe sector is likely to do well, and the order flow is also robust. So I think it's a good stock to be in, but not at a level of today where the stock is already up 8 and 9%. So I think you should wait for some kind of consolidation. Maybe around say 1500, 1550 level should be a good one for any long-term investor to enter into the stock. I think the robust performance is likely to continue, and one should always keep an eye on companies which are into water and pipes as a sector.
So let me extend that question then, and interestingly, so there has been comments about the pipes companies, right? So you have Prince Pipes, you have Astral. Would it be right to say that this is part of an overarching building materials theme? And therefore, if I talk about a larger building materials theme, would you prefer this segment of the market or would you prefer another one?
The building material includes, building material for real estate, commercial, as well as for infrastructure. I think, and as you rightly said, it has got an overarching implications. So companies like these also cater to the real estate and also the commercial infrastructure, as well as the capex infrastructure side. So I think that's again a good play, because these companies with the kind of profits, with kind of margins they have, they will be very happy to expand to those areas as well where they are not present currently. So I think that provides a good diversification to their sales streams, as well as for an investor it also gives a better exposure towards all the three sectors which are correlated to infrastructure development.
Okay, fair point. But if I were to push you to say, okay, should you look at Astral or should you look at another player in the building material space, then would you choose another?
Well, Alex, I haven't studied the other stock in the sector as well.
No, I'm not talking about pipes per se. I'm saying the broader space. So sanitary ware, or you're talking about tiles companies. What, according to you, would be something to look at?
See, in the same space, I would prefer to get into the cement as a sector.
Okay, fair enough.
Which has got the overall usage for even for infrastructure development as well as for the real estate side. For tiles and for sanitary ware, again there is some kind of skepticism in terms of with the higher interest rate, whether the real estate sales would take off maybe on the mid and affordable side because of the higher interest rates. That's again to be watched out for. But again, on the luxury segment, I feel that the demand would remain inelastic. So companies like this, don't make for luxury real estate, or the brand positioning is for affordable and mid-size. So I think there can be a lot of volatility in terms of sales. So I would refrain from getting into those sanitary or.
Fair point. Let's talk about a new age company, food tech. I think it's been in focus, Zomato, but not just for its own name, but because of its pure player, which is Swiggy, which has seen its valuations cut pretty sharply by two investors. The latest is by a US investor, Barron Capital. It's cut its valuation by 34%, and leading some to suggest that maybe Zomato also should be reevaluated. But there's also this conversation about ONDC denting the food delivery business, so to speak, if it expands the way that it seems to be forecasted to. So what's your reading of Zomato right now, and what should investors know about?
See, Swiggy's downgrade came post, the valuations which was seen on Zomato on the public market side.
Yeah.
I believe, that 25-30% of the commission regime is going to be under threat with, ONDC trying to grab that piece of market share with its commission structure of 2 to 3%. I think there's going to be, a threat coming from ONDC definitely, and these, food delivery companies need to really, optimize their margins, as well as ensure that, the pricing is more or less in line with what the new entrant is, quoting at. So there is likely to be a competition, and the kind of valuations which we had seen in last year, when Zomato got listed, I think that kind of valuations was an aberration. I think that things will rationalize definitely. And from here on, it's very interesting to see how Zomato is, increasing its sales number as well as, bringing the profits on the table. So a cut from on Swiggy is also, likely to be watched carefully by listed entities like Zomato. So I think ONDC becomes a bigger threat, and I don't see the kind of valuations which Zomato on a listed space had commanded last year. There needs to be a lot which is required to be done in terms of their margin, in terms of their profitability. So I think the next couple of quarters would be quite interesting to watch out for.
Interesting. So would you say wait and watch for Zomato, or would you say that you can nibble into the stock at this point?
I think it should be wait and watch, because we also need to very closely watch how ONDC is able to create that kind of dent. Because what Zomato currently has is their own delivery network, while ONDC still relies on a third party, and the reliability of delivery and those needs to be tested. The kind of user feedback needs to be tested. Personally, for me, I had placed couple of orders through ONDC, and my experience has been pretty impressive. They were on time, and in terms of the pricing which I got was way cheaper than what you get on a delivery app like Zomato. So and then this needs to be tested, and this needs to be tested across cities. The ONDC is present only in few cities. I think there are interesting times ahead. So I believe that wait and watch should be a right option.
Interesting. I should take you up on that. I should try the ONDC as well to see how that is. Let's talk about the last set of companies, which is the oil producers, and that's on account of the latest update. The finance ministry has cut the windfall gain tax for this fortnight starting today to 0, and that seems to be the reason for the latest pop. But beyond that, of course, let's also talk about crude prices. Let's also talk about where things stand right now. How do these companies look?
Well, this windfall tax cut should not have much impact, because this has become now a fortnightly affair.
Yes.
Yeah, in terms of oil marketing companies or oil producing companies, I feel let's take up oil producing companies first. The kind of global outlook is there, which is pretty dismal. So we are not sure how the crude demand is likely to be in next couple of quarters. So that may have some kind of negative impact or a overweigh on the stock prices. In terms of oil marketing companies are concerned, I think we have elections ahead, and the kind of crude oil which has, the kind of petrol and diesel prices which has stabilized for a city like Mumbai, it's around 106 rupees for almost few months now, for if I talk about petrol prices. So when election days are closer, we may see some kind of intervention coming from the state government and central government, and there could be reduction in price. So that may have some kind of impact on the margins, on the autonomy of how the oil marketing companies are functioning. So till the time 24 elections are over, I think, and the kind of outlook we have for global markets, I think it's better that you should be cautious about the sector overall. So I feel that this sector can be avoided for the time being.
Fair call. Thank you so much, Jeff, for taking the time. Pleasure speaking with you always. And thanks so much for speaking to BQ Prime.
Thanks.
Viewers, do stay tuned. I say this often, but this is the case today in particular. Lots coming up over the course of the day. Do stay tuned.